Startups are dying in droves in a, quote, mass extinction event as 10 years of zero interest rates now adds mass bankruptcies to the inflation that, according to fresh numbers only this morning, is not going anywhere. The Wall Street Journal ran an article last week going through the grim numbers in startup land with soaring shutdowns, quote, fire sales, and hard pivots, meaning the business failed, so they're trying something else to use up the money. In short, after the Fed intentionally hiked interest rates last year to crush the economy, both bank loans and venture capital essentially dried up. This is now driving tens of thousands of small businesses to the wall, or as the Journal dryly put it, quote, business models that worked when cash was cheap are unsustainable now. By the way, this is a key mechanism in the business cycle model in Austrian economics, that the main driver of recessions is the boom-bust cycle, where cheap money fuels a bunch of unsustainable businesses called malinvestments, and then all of that cheap money fuels inflation, which drives the Fed or the central bank to fight it with rate hikes. The rate hikes take away the punch bowl of the cheap money, causing those malinvestments to go bust in droves. So rather than businesses occasionally going under one by one, like in a healthy economy, the failures cluster around those interest rate hikes, which were only necessary because of the previous zero interest rates. So at the moment, we are in the middle of an epic hike cycle after, of course, 10 years of zero rates to pay for. So the Journal's, quote, mass extinction is textbook Austrian business cycle theory. It is nice to see mainstream talking about the trees, although perhaps someday they'll learn the theory. Now, in raw numbers, VC activity is now down 2/3 in just over a year to just 37 billion. The Journal mentions one VC firm where barely half of their original portfolio companies are still around. The rest already went bust. As an industry, the internal rate of return for venture capital firms is now negative 7%. So they are losing 7 cents on every dollar they invest. As one VC put it, quote, it's like the entire industry went out drinking and is now suffering the consequences. Yes, it is amazing what cheap money does to you. One prominent failure was robotic pizza maker Zoom, which went from 2.25 billion to being sold for scrap. By the way, when I used to teach malinvestment in class, I would use the absurd example of a restaurant built in a whale's mouth as an unsustainable business. I might now have to revise that to a 2.25 billion robot pizza guy. So what's next? There are still a lot of zombie startups sitting on leftover money. Almost 350 billion was raised in 2021 alone, and they're still running through it, meaning we have only seen the beginning. Every month that passes, more and more startups are going to get to the end of their rope, and they'll liquidate, fire employees, exit their leases, and join that mass extinction off the cliff. How to stop it? Easy. Bring interest rates back to a reasonable number, say 2 or 3%, so the liquidations don't cluster all at once, which you could do if the federal government stopped pumping inflation with their deficits. As for stopping these endless cycles of inflation, recession, bailout, it's even easier. End the Fed and let markets, meaning let the people, set interest rates as they had for centuries. Of course, that is not happening anytime soon. Okay, we'll be watching. See you next time.